Welcome to the OR Talks podcast. Here are your hosts, Neil Seeger
and Marc Jovanovic.
So we're back.
We are. It feels like it's been a while.
It has been a while. We've got past the January madness.
That's it. So those of you that don't know, January is probably our busiest time of year, isn't it? January and December.
It is. All the tax returns, all that sort of stuff that comes in. So we're going with the new year and we're changing how the podcast slightly works. So we're going to go with that. We start off with a myth of the month. Okay, Marc's myth of the month. I think it's a nice way to word that.
Yeah. So that will just be busting things that you've probably seen all over social media, telling you the finer detail that they don't tell you.
Absolutely. Digging into a bit more detail. So I'll have one of those coming shortly. Then we'll have a main section which will talk about a hot topic that's coming up, and today we'll be discussing MTD, so making tax digital, which is affecting a lot of self-employed people, and what that really means. We'll go into that one in a little bit more detail. And finally, we've got one last section which it doesn't work with this one because we've got Marc's myth, MM. Now it doesn't really work when you have Neil's knowledge, which is spelled with a K.
Just have to ignore the K.
Exactly. So we'll have NN, so Neil's knowledge.
We start with numbers, not words.
Exactly. So we'll be talking about important things to note that are coming up soon, or things that to be aware of. So we'll go into that in more detail later on. But that's going to be the three sections we're going to be using going forward, and try and build a structure around that. So if you have anything you would like to, we'll say this at the end, but if you would like to have anything you'd like us to talk about, then please just let us know. We'll give you the number at the end. We won't have that little spoiler on that one. So, start off with a new structure.
So Marc's myth of the month. Something you've probably seen all over TikTok, all over Instagram, all over social media. Videos telling you can take £50,000 out of your limited company and only pay 8.75% tax.
That's amazing.
It is. It does sound really good. However, it's not the full picture. What they never mention is that the company's also got to pay corporation tax before you can take that money out.
Oh, so that's just talking about me taking the income out of the company?
Yeah.
Right.
It's a really, really catchy thing that people say without the finer detail. It sounds too good to be true, and that's because it actually is.
So if I had a profit in my limited company of £50,000, I took the whole lot out. Okay, I pay my personal tax of 8.75% tax on let's keep it simple, pay my 8.75% tax. And then I come to do my company year end.
Yeah, so you've got to pay up to 25% tax on that £50,000 profit. You've got to have the profit there to be able to take it out as dividends.
So I can't just draw it out?
No, sadly not. And what you draw out as a dividend is not tax deductible for the company. The dividend is after tax.
Right, so therefore then I've got to, so in order to have 50 grand out my company and pay me 8.75% tax, my company has got to have made
more than 50,000.
More than 50,000. So at least sort of £60,000 worth of profit. So let's just say it's 20%, keep it really easy. Then I'll take it, have me 62 grand, pay me corporation tax, which gives me 50, and then I can take that out.
Exactly, you've got it.
So they don't tell you that on the videos.
They don't, but taking out as dividend is still really good because you're saving on the national insurance.
So it's better to still really good to have salary and dividends at that level, but I've just got to build into the fact of my planning, my corporation tax. I can't just look 50 grand in the bank and take it out.
Exactly.
Right. That is a myth that I have seen all over the internet, and I've seen the video. I'll probably see it twice a day. Pop up. Before work and lunchtime, obviously, and it's so you'll see that all the time, and you think it's brilliant to be a limited company.
You do, and it is really good to be a limited company. There's lots of advantages to it, but saying that you can just take 50 grand out of the company at 8.75% doesn't tell you the whole story, and that's what you should speak to us really, and we'll
break it down.
Yeah.
So in reality, then you're talking about your potential tax liability being, if it's 19%, let's just say, corporation tax. So you're talking about your actual tax being 27.75% tax.
Exactly, yeah.
Right, okay.
Which doesn't sound quite as good.
It doesn't sound quite as good, does it? It doesn't, does it? It doesn't. Not when you're comparing it to self-employed. I'm not going to go off on a tangent here, I promise. But when you talk about self-employed being 26%, actually, it's worth bearing those numbers in mind.
Exactly, yeah.
I knew that. See? Mythbuster. So I think that's the only myth that I've really sort of a hot topic of mine that I've seen.
Yeah, so for this month, that we'll leave you with that one, and then we'll debunk another one in the next month. So stay tuned.
I'm looking forward to the next myth of the month, Marc's myth of the month.
And if you see any myths out there on social media that you'd like us to look into, or something that sounds too good to be true, just drop us a message and we can have a look
build that into our next one. Yeah. It doesn't have to necessarily be your myth of the month. It could be anyone's myth of the month.
Anything you're seeing. If it sounds too good to be true, it normally is.
It is. So the other part, the middle section we're going to talk about is MTD. Okay, this new thing that's coming out called Making Tax Digital. Now we had that a few years ago when we were talking about VAT.
Yeah.
So now this new thing for MTD has come out.
For income tax.
Right.
But it doesn't change how you pay your tax.
Okay. Yeah. So let's break that down a little bit. So what does that mean then? So it's changing from the 6th of April 2026.
Yeah.
Is the first tax year. Okay. So how are they assessing that? What are they?
So in the previous year, if your turnover was over £50,000, you are going to have to report quarterly your income and expenses.
Okay. So if I've got a self-employed business, so there's only self-employed individuals.
Yeah.
So if I'm a sole trader and my turnover, it's not profit, it's turnover. So if my turnover was £48,000 in the tax year to let's say 31st of March 2025 accounts, I'm not hitting within this at all.
No, if that's your only self-employment of £48,000 turnover, you're not in MTD yet.
Okay. But if I then had £60,000 in the 31st of March 2025 tax return, I have to file my numbers quarterly from the 6th of April 2026.
Yeah, correct.
Okay, right. So, but that's self-employed people, because it's two sources of income, isn't it? It's self-employed and land and property.
Yeah, that's it. So rental income and you're self-employed. Anything else doesn't come into it.
So if I had, let's just say, I had £4,000 of the rental income, and my £48,000 of the self-employed income. So income, not profit, income. That's 52,000. That puts me in.
Yeah, you're in. Then it's the two combined.
Right. Okay. So if I've stopped being self-employed, this is going to be one thing that catches people out, I think. If I've stopped being self-employed and I've gone limited company, because I heard this was coming and I've set myself up a limited company, and so therefore I stopped on the 31st of March 2025. So now I'm not self-employed, but I have my limited company, but I still have a rental property with £4,000 a year. That hasn't changed. Am I still caught?
You are, because you have to fall outside the requirements for MTD for 3 consecutive tax years before you can come out of it. So although you're only going to have that rental income, which is below the threshold, you're actually still going to have to do MTD.
So because I would have thought that if I stopped, I'm now not caught, but I am caught.
Unfortunately, yeah.
And then I've got to do that for 3 years, file my numbers quarterly, for 3 years before I can drop out.
Exactly. We say, unfortunately, it's not the end of the world. It's something we can help you with as well. It sounds really daunting and really scary, but it actually isn't, is it?
It's not, and there is various different ways we can do it. You can do it via software. We can do it via our softwares. There's various different ways we can file those numbers.
Yeah.
But so those quarters are going to be April, May, June.
Yeah.
So it follows the same thing as the VAT, I think, doesn't it?
It does.
So it's April, May, June, and then you've got 1 month and 1 week to file that. So it will be. So you'll have the whole of August. So it'll be effectively. So it'd be the 7th of August you have to file it, wouldn't it? So it would be April, May, June. You'd have July, and it'd be 7th of August.
Yeah. So there is plenty of time to sort out your figures for that period. Because you've got a month and a week to do it in.
So and then those numbers are just your income and your expenses. They have to be filed quarterly to HMRC.
Yeah. And you don't have to pay any tax any earlier. The tax payment dates are staying the same. So no changes to that. It's purely reporting to HMRC what you've done in that quarter. If you're already registered for VAT, it'd be fairly straightforward.
It just follows the same, I suppose, doesn't it? So then if you do, so you've got 4 quarters. Obviously, I'm very good at maths, you can tell, 4 quarters. So you do your 4 quarters, which finishes obviously at the end of March 2027.
Yeah.
So then I've done that. So then is that me done, or have I got to do a tax return?
You still have to do an end of year statement, which basically brings all those 4 quarters together. You put any tax adjustments in then, because as you're going through the year, there won't be things that you adjust for tax. It's just purely what you've spent and what you've had come in.
Yeah.
And then you'll also pull in any of the sorts of income that you've got. Say if you've got dividend income from shareholdings, bank interest, a bit of employment, that all then comes into the end of year statement.
So it's 5 submissions.
Yeah.
So it's 5 submissions now. So then I've done my 4, then I've done my March one, my end of year statement. So then my tax then, because that's up to March 2027. So my tax is then due, like it used to be, at the end of Jan 2028.
January,
and then I still pay my July payments.
Yeah, if you're in payments on account, you still pay.
So nothing changed the way I pay tax. I've just got to file 4 more submissions.
Exactly.
Okay. There's an awful lot going on with that.
There is. It's basically HMRC just wanting to get a picture of what everyone's doing throughout the year, probably to help them forecast what tax liabilities to expect rather than waiting to the last minute.
Well, I suppose it will help me from my tax planning point of view, because I'll be able to see what profit I've made every quarter and to make sure I've saved up enough tax.
Exactly that, exactly.
So there is a positive.
There is, yeah. Once people get into the habit of doing it, I think it'll be absolutely fine. It's just going to be a bit of a change for the first year or so.
It's like it was with that. It's the unknown, I think, is the one thing that is the worrying part about it.
It is, but there's software and there's us out there to help you with the software that can help you make it all really smooth and painless.
So, if in doubt,
get in touch.
Absolutely, give us an ask. Perfect. There's no such thing as a silly question either.
No.
You know, you can probably see the way that we're breaking it down. Actually, you know, this is hopefully sounds like it's not quite as daunting after listening to us, but it is you know quite complex if you don't know it.
Yeah, and don't ignore it. It's not going to go away. If you're over the threshold, you're going to have to do it. So don't bury your head in the sand. You might have had a nudge letter from HMRC telling you it's going to happen. I know I had an email yesterday telling me, "Am I prepared?" Yes, luckily I am prepared. I'm proud to say I am prepared. I'd be worried if you weren't.
I mean, yeah, I'm sat here talking about it. I've just left it, but everyone else should. No, absolutely not. I'm prepared, and we're all there. But there is an awful lot more coming out from HMRC as well, which is nice. But don't panic if you see an email and you don't know it.
And we've got loads of information on our website as well.
Absolutely, yeah. That's a good point. Yeah.
Always there for a plug.
Absolutely. Absolutely. I was going to ask you for the web address then. I'm not going to do that. So that's the real hot topic at the moment that I don't think we're going to go through any more on MTD, because we could go on about it all day, but I think that outlines the main key points. Yeah, and we have done podcasts on it, so if you want to know a bit more, have a listen back to one of those, or please just get in touch with us and one of our team can talk you through what you need to do. Perfect. So, on to Neil's knowledge. Neil's knowledge. So, which I mean, there's not much. So, what we got to do? So, we're coming to the end of the tax year. So, we are currently in February. So that means we have 1 month, approximately, until the end of the tax year, which finishes on the 5th of April 2026. So, there's key things allowances that people don't remember they've got, don't utilise, and once you haven't utilised them, they've gone. Yeah. So, the main one is your personal allowance. Yeah. Okay, so I talk to an awful lot of people, as you can probably imagine, and it's looking at their income sources and so people don't want to draw pensions, for example, because they don't want to pay tax on it. I had a client of the week where they've only taken £6,000 out of their pension that year, which means that they actually they're wasting at the moment £6,500 of their personal allowance. So they can take out more out of their pension or cash in one of their other pensions. Not the tax-free cash, just start drawing is probably the better way to put it. Start drawing their pensions to utilise it. So if you've got income less than 12,570, make sure you utilise your allowances. Yes, otherwise you could end up paying tax on it in future years when you haven't got spare personal allowance left. Absolutely, don't waste it, because once it's gone, you can't carry it over to next year and say I only used £6,000 last year. Can I have the other 6? Can I have 18 this year? Yeah. The answer to the question will be no. It'll be it's lost. Yeah. And following on from that, there's the marriage allowance transfer as well. So if you're married, there's a good way of, if you're not using all of your personal allowance and your partner is a basic rate taxpayer, you can transfer 10% of your personal allowance to them, which then gives them a handy little tax saving. So let's just say it's me and you. Congratulations, we're married.
Married or civil partners?
Yeah, absolutely, yeah. So let's just say we're married.
Yeah.
Okay, so therefore then I've only earning my £6,000.
Yeah.
Okay, you're earning £48,000.
Yeah.
I can transfer 1,200. Why am I wording like that? 1,270 quid. There we go. Of my allowance onto you, which means that you save 20% tax on that.
Exactly, yeah. So it's a few £100 better off in my pocket that I would obviously spend on my other half.
Absolutely, absolutely. That's very kind of you. Thank you. We're expecting a very nice Valentine's Day present.
Yeah. And if you haven't done that in previous years, you can actually go back and put a claim in for up to 4 years. So if you haven't already done it, might be worth looking into.
Definitely, that's a really good point. Actually, I hadn't thought of that one. That wasn't in Neil's knowledge. But it doesn't work with Mark's knowledge. It doesn't really have the same.
You triggered it in my brain.
So then the next one is our dividend allowance.
Yeah.
So as we're speaking right now, you can have £500 worth of dividends tax free. So if you've got shareholders in your limited company, which have got shares, and we're not paying them a dividend currently, it might be worth looking at paying them a dividend.
Yeah, and that can't be rolled forward. So if you don't use it in the tax year, you've lost it.
It's gone.
Yeah.
Well, that's the same with all of these.
Yeah.
Well, hopefully, probably all of these. Your next one is the savings allowance.
Yeah.
So a lot of people that put their money in ISAs, this doesn't affect you because ISAs are tax free. But if you've got interest, and we're looking, so you've got one taxpayer who says me and you again, I've got everything in my account. And I'm a basic rate taxpayer, so I can receive £1,000 worth of interest and pay no tax on it. If I'm a high rate taxpayer, it's only 500, it's halved, isn't it?
It is, yeah.
So therefore, if I'm a high rate taxpayer and I've only got my £500, but I've got my partner who's a basic rate taxpayer and you get 1,000, if we put that into a joint account, then half is yours, half is mine. And it would half the effect.
Just makes better use of the allowances.
It's all planning, isn't it? It's all looking. So if you've got if you're in that situation, it's worth looking at before the end of the tax year, because again, you don't get to carry it forward. You get £2,000 next year, it's gone.
Yeah.
You've then got your inheritance tax allowances. So what we're saying there is, if your estate is £325,000 or less, you get a basic allowance, don't you? You don't pay anything. But on top of that, you get an extra £175,000 per person if you're leaving your residential house to
your direct descendants, so children or grandchildren.
Okay, so if it's me and you, and we're married, we've got £1 million.
Yeah.
Perfect. Right.
Providing your estate doesn't go over 2 million. We've done little bits on that before, but that's the basics of it. So
therefore, when we're looking at our tax planning and our strategy of our estate planning, it's worth considering where that sits. That's not per year. You don't get an allowance per year. It's looking at your estate. Yeah. So it's worth considering that.
Yeah, but from an inheritance tax point of view, it's worth remembering that each year you can give up to £3,000 completely inheritance tax free. So I could give to, doesn't work with married couples, so forget we're married now for a minute.
Okay, we're now not married.
Yeah. I could give Neil £3,000 and that would fall out of my estate for inheritance tax completely. And unlike most other allowances, if you didn't use it in the previous year, it can be carried forward. So I could actually give Neil £6,000 if I didn't give him anything in the year before.
So it's only carried forward 1 year?
Yeah, only 1 year, yeah.
Right, okay, so that's always worth looking at, because when you're looking at estate planning and gifting, you're always worried about that 7-year rule.
Yeah.
So that doesn't affect that 7-year rule.
It falls completely outside of it. And the reason I said it doesn't work for married couples is because spouse-to-spouse transfers are completely out of inheritance tax anyway.
Ah.
So children, grandchildren, you could give them £3,000. That's £3,000 in total, not £3,000 each.
I was about to ask that. You beat me to it. I could see it. I've got 10 grandkids. Does that mean I can give away 30 grand?
Sadly not. Sadly not. Can split it between them, the £3,000.
But there are other ones. So there are other reasons you can give money.
Yeah.
For like marriage and
there's birthdays, marriages, things like that. So it's worth using those in the tax year. So coming up to the end, if you haven't gifted anything and you're feeling generous, make use of the allowance.
Absolutely. Thank you, Mark. Not feeling so generous, no. I was waiting for me 6 hours, wasn't up you then.
If I had it near, I'd give it you.
Oh, very kind of you. So the other one that I'm speaking to a lot of people about at the moment, and having a lot of meetings, is pensions.
Yeah.
Pensions is really, really, really a very hot topic again at the moment. Not as hot as MTD, I wouldn't have thought, but it's up there.
Yeah.
So anyone can have £60,000 that they can contribute into their pension a year.
Yeah.
Because if they're not drawing one, okay,
Yeah.
so we'll forget that anyone that's not drawing a pension currently can put. So I have a limited company that's making £500,000 profit.
Yeah.
I want to save corporation tax. One of the things I can do is put in £60,000 out of my company into my pension.
Yeah.
Okay, and I will save 25% corporation tax on that, and I also utilise my allowance.
Yeah.
So one of the things I'm talking to my clients about at the moment is they put their monthly amount in, and towards the end of the tax year, based on profits, they will put a top up into their pension.
Yeah.
So if I put £20,000 into my pension already, I can top it up by 40.
Yeah, that's right, yeah.
But there is a point on that one, isn't there? I know you're going to tell me on that one.
There is, it's whether it's company or personal putting it in. So if you put it in as a company, it's treated as a gross contribution, so you don't have to worry about anything else.
Yeah.
If you're putting it in out of your own personal bank account,
Yeah.
that's classed as a net contribution, and that gets grossed up, then gets grossed up to the £40,000. So you just have to be a little bit careful around that, but it's worth speaking to us, because like the inheritance tax one actually, that allowance, if you didn't use it all in the previous 3 years, you've got to carry forward. Right. So you might be able to put more in if you haven't used it in previous years.
So is it current year plus 3?
Current year plus 3, yeah.
So therefore I could do £60,000, so that's 240,000 today.
Yeah.
Write a cheque. I could write a cheque for 240,000 and whack it into my pension, save the corporation tax, and utilise my unused allowances.
Yeah, with the corporation tax, it has to be commercially reasonable to be putting that amount in. So just because it's your company, you've got to be reasonable that you do it for someone if it wasn't their company as well for the same role. But
good point. Good point. See, it's always these little points. No, it's good to bear in mind though, isn't it? Because that's see how simplistic some people would look at it and go, I've got the money in the bank, I'm going to put it straight in there. But actually, that's where people get caught out, because then HMRC will question it and say, is that reasonable? And you're like, well, no.
That's why you speak to us. These are ideas, and if you think it might be suitable for you, speak to us and we can tell you whether it will work in your situation or not.
It's case by case, isn't it?
It is. It always is.
It is always a case by case.
The other thing with pensions, that if you're a high earner, say earning between £100,000 and £125,000 a year, that's the worst place to be in tax, isn't it, as an individual? Because you're losing your personal allowance for every £2 you earn over 100,000. So putting in a personal pension contribution actually does something for what's called your adjusted income.
Okay.
So it can bring you back under the 100,000 and save your personal allowance.
So I could have a salary of 130,000.
Yeah.
Right. Let's just 130,000.
Yeah.
And then I put in £32,000 into my pension.
Yeah.
That means I've got an income of 98.
Yes.
That's my adjusted.
Yeah.
So I get my personal allowance back.
Yeah.
I get a tax refund.
Yeah.
Oh.
What a place to be in.
Yeah.
And you've got putting the money into your pension for the future.
Which has then got the growth that comes with that as well, which is financial advice. So I'm not going to run into that, but effectively that's how it would work.
It's a really good thing.
Terms.
So losing your personal allowance is the worst place to be. Then the effective rate of tax works out just over 60%. So.
Wow, that is expensive.
Yeah. So putting it into your pension, if you can afford to,
is a good way. So so coming towards the end of the tax year, those are the questions and the things that we're talking to our clients about.
Yeah.
You making sure we don't waste an allowance, because if you as you say, it's the current year plus 3. Well, once you've gone past this one, you've then lost what it was, the one for 4 years ago.
Dropped out.
So effectively, you're a year behind. So it's always worth looking, if you can, to top it up potentially. But again, it's case by case. Some people it works for, some people it doesn't. But it's worth looking at. Pensions is a very very common one. So the next one, which is another hot topic, because the budget that was last year, so the autumn statement, no, not autumn. Yeah, it was autumn statement.
Autumn, yeah,
it didn't feel like it was autumn because it was so late.
Yeah.
So it was the autumn statement. So during that statement, they explained that the ISA allowances were changing. So historically, you could put £20,000 a year into your ISA. Was that was stocks and shares and cash? They were the same.
Yeah, yeah.
So could I put 20 into both back then, or was it just 20 in total?
20 in total.
20
your
in total.
ISA allowance.
So that's changed now, hasn't it?
It's changing from April 27.
Right. Okay. So it's not in just yet.
No, but it's worth bearing in mind. It's going to be changing. So the change they've made is you can now only put £12,000 into a cash one.
Yeah.
The rest would have to go into a stocks and shares one. So you still have a £20,000 allowance, but you can't put it all into a cash one. Only £12,000 can go into cash.
So it's 12 into cash, 8 into stocks and shares,
Yeah.
or 20 into stocks and shares.
Yeah, but all in stocks and shares.
Okay. But the maximum I can put into my cash from April 2027 is 12,000.
Yeah, and anything that you earn in that ISA then is tax free. So
it is also worth bearing in mind.
yeah.
That is.
So if you haven't already used your allowance for the year, come to the end, make sure you use it.
That's a perfect time now, isn't it? Because
Yeah.
in fact, actually, the rules changing it going down now is a good. So for basically for this one that ends on the 5th of April 2026, and the one that ends on the 5th of April 2027, you want to max your allowances because it's going to reduce. Then
Exactly.
going forward. And you don't get your allowance carried forward, do you?
No, it's a 1 year thing.
You can't use 10 this year and 30 next year.
No.
It's once it's gone, it's gone. So
Yeah.
that's quite an interesting point that is really worth bearing in mind because it could earn you a couple of quid. So the other thing is we mentioned about personal allowances. So we have a personal allowance for income tax, but then we also have a capital gains tax free allowance.
Yeah.
Which is £3,000 currently per person.
Yeah.
So if we haven't used that, so if you've got a nice painting on the wall and we're deciding we do want to sell it this year or next year, then we want to make sure that we sell it this year because we'll get our £3,000 allowance. They're not changing that, so I haven't said they're going to yet.
Not at the moment. It used to be a lot more generous. It used to be 12,000 and it's been rustled away over the years. So now it's £3,000 per person. And it can't be carried forward either, so it can be worth crystallising gains.
So we have quite a lot of conversations with clients about crypto, and stocks and shares.
Yeah.
So if we're looking to cash out and actually deciding whether to do some now and some next year, then you'd probably make sure that your profit is, if it's £3,000 or less this year, and then £3,000 or less next tax year.
Yeah.
So if we're looking to cash some out, it's worth calculating. Actually, if we're going to do it now, take some out now and then take some out after.
Yeah. So you get two allowances.
You get two allowances. Yes. Right. Instead of if we had £6,000 now, you're paying tax on £3,000 of it at capital gains tax rates. Whereas if we split it into two, then you don't pay tax on it.
Yeah, and it's on the profit, that is, not what you necessarily take out.
True.
So that's what you sell it for, that's what you bought it for, effectively.
It comes out to your profit, so hopefully keep it below 3. But if it's a joint account, then that'll be 3 each.
Yeah, exactly.
So it's always worth considering how that all sits and how we do going forward. I think that's all for Neil's knowledge.
It's been good. Been a lot of knowledge.
I've run out of brain capacity now. I haven't got any more knowledge. That's me done for the day.
I never knew you knew so much.
It's amazing what you can learn sitting here with Marc. Just absorbing information.
I've learned from you. That's good.
So that's the new format we're going to use for the pod going forward.
Yeah.
Hopefully that's is very informative. But we'll try and find hot topics every single month for you. And if you have got any suggestions, I said at the start we give the number out.
Yeah, get in touch on 01905 777 600. Drop us a WhatsApp.
Absolutely, and we will build that into our pod going forward.
But yeah, if you do want any more information on anything, don't hesitate to get in touch, and someone will be happy to help you.
Thank you for joining us.
Until next time.